This is the Asia Trade. I'm Annabelle Droulers in Hong Kong.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Oil prices are fluctuating at the Asia Open after President Trump's ultimatum to Iran to reopen the Strait of Hormuz by tomorrow. Stock futures signalling further losses, bonds selling off as inflation fears have traders adding to bets on a Fed rate hike this year. No sign of de-escalation in the conflict, with Iran threatening all US and Israeli infrastructure in the region if Washington attacks its power plants.
And I'm Stephen Engel in Beijing at the China Development Forum, where Premier Li Qiang is promising to address China's massive trade surplus. We'll hear later this morning from PepsiCo's Asia-Pacific CEO Ann Tsai, McKinsey's Greater China Chairman Joe Ngai, and S4 Capital boss Martin Sorrell.
Well, let's get straight to these markets. This as we're just about hitting that 24-hour mark. We had, of course, that Truth Social post being hit send at 7:44 Saturday night. President Trump really issuing this ultimatum that will expire in just about 24 hours' time. We'll have to see how it plays out. At this point, we don't see either side really backing off at the moment. Iran threatening to retaliate if the attack on those power plants go through, which, of course, was a threat if the Strait of Hormuz does not reopen. Take a look at oil prices. We see some fluctuations. There's a sense that perhaps traders are getting some of that fatigue, right, from all of the to and fro and the drama at the moment. This is what we're seeing, particularly as we head into the start of trading of Asian equities as well. Brent crude, as well as New York traded crude, looking pretty lackluster at this point. We're also watching Asian energy shares. They should get a bit of a boost as we have that ultimatum still to contend with, and we have seen some of those stocks in Australia trading particularly higher. But also taking a quick look at gold, which at the moment we are seeing a little bit of a gain as it rose after the worst week in 4 decades. The war risks are mounting. The implications for the dollar and the Fed are also mounting too, Bill.
Yeah, certainly, Heidi. I mean, it's that just general story. Are we going to see inflation igniting once again? Are we looking at further rate hikes from a range of different central banks? But coming into the session today as well, I mean, as you said, we are going into week 4 of the conflict. I think our guest in the next hour actually has a really interesting point on this, because he's taking a look at historical precedences, starting from Iraq invading Kuwait in 1990, all the way to the 2026 Iran war. And he's saying week 4 is actually when you see peak uncertainty moving through markets. So very much that could sort of set the tone as we head into another week of trading. Looking at the Kospi there, guiding for a 4% drop of the open. Chicago Nikkei futures, again, similar sort of magnitude. But let's get into the top story, of course, because US Treasury Secretary Scott Bessent says the US is in control of the Iran war. He told NBC that the US and Israeli attacks on Iran are aimed at destroying its fortifications along the Strait of Hormuz.
Every day we are taking out their missiles, their missile systems, and the factories that build those missiles. And now the General Kane, Secretary Hegseth are leading a campaign to destroy all the fortifications along the Straits of Hormuz. Again, they're not mutually exclusive. Sometimes you have to escalate to de-escalate.
Let's bring in our Washington Deputy Bureau Chief, Laura Davison. So, Laura, what a weekend, really, of very mismatched commentary coming from Trump himself. We already know that many people within the Trump administration weren't actually that keen on even instigating this war in the first place. But just bring us up to speed on exactly what is the latest.
Really, just going back the past 72 hours, we heard Trump on Friday say that the war was winding down. That was a signal that markets investors took as, okay, maybe the end is in sight here. On Saturday, just about 24 hours later, he said that he gave Iran this 48-hour deadline to reopen the Strait of Hormuz or else it would start attacking energy sites. Remember, that was a complete reversal from Trump just a couple days prior, where he was, in fact, angry at Israel for attacking those South Pars oil fields in Iran and sort of had attacking oil infrastructure as a red line. Of course, Trump's goal here, at least what he's kind of really singularly focused on, is opening the Strait of Hormuz because of the effect on oil prices. Of course, if there's escalatory attacks on energy sites in the region, that would only further damage and further prolong sort of these high oil price scenario that we're seeing here. So this is sort of a conundrum that Trump now finds himself in, is that he doesn't really have a way off of this war. He Iran, for their part, the Strait of Hormuz is their ace card. That's the last thing that they're going to be willing to negotiate on, because that's the way that they have leverage over the situation. That's what Trump is singularly focused on. Allies are not coming to help, and he really, does not have an easy off-ramp out of this. Though it looks like, that he is looking for some sort of way, to rhetorically end this war. He said over the weekend, Iran has died. He's now focused on the Democrats and Congress and spending fights there. Of course, this war can't end just because he says it does.
Yeah, and as you said, though, he's gone so far in that pledge that he doesn't really have an off-ramp at this point. So given that, as Haidi said, we're roughly around that 24-hour mark now, we've still got another day left. What are you watching for in the next short-term period, essentially?
One is, does Trump change his messaging at all? Does he try to extend this deadline at all? Does he try to buy a little bit more time? Iran has, is stepped up, in fact, its attacks. There have been several reports over the weekend of Israel being hit much harder here. And Iran has also pledged to hit lots of Western infrastructure in the region, desalination plants and other IT infrastructure for the U.S. and its allies there. So that, really only continues to be sort of a bigger war on the future if all this comes out. But Trump loves to set these deadlines and then, potentially extend them later on. So this is, while it's a 48-hour deadline, that's a deadline he said. It's completely arbitrary, and we could see those goalposts move if he gets cold feet here.
Are the goalposts the same for the US and Israel? Because I do wonder what will happen if President Trump wants an off-ramp, but Israel, Benjamin Netanyahu, wants regime change. How does these two goals kind of work into how this war goes from here?
This is a huge question. Trump has said, both ways. He a couple weeks ago told an Israeli newspaper that any decision to end the war would be a mutual decision between the Israel and the U.S. Since then, he's changed his tune a little bit. He's kind of distanced himself a little bit from Israel and Netanyahu, though, as we know from reporting from our colleagues over the weekend, that Netanyahu was one of the key voices really pushing Trump into this war, along with Rupert Murdoch and some other conservative commentators, where he doesn't, where his own key, allies in the White House, people like Susie Wiles, the White House Chief of Staff, J.D. Vance, the Vice President, were quite silent on this issue. So those voices, Netanyahu's voice in particular, has a lot of weight as this continues. So we should, anticipate that he will at least closely listen to what the Israelis have to say, even if it isn't a decision that's made in concert.
Laura, what do we know in terms of conversations around the possibility of ground troops and what that could look like?
Yes, there's been, several reports that ground troops could be going in. That's something that Trump and White House Secretary Carolyn Leavitt have continued to say are, sort of a possibility, but not something that they're moving forward to. And this continues to be a campaign from the air. But this is, there's been lots of different machinations here, particularly as it comes to securing the Strait of Hormuz, of having troops go in there, open that up. We also know that there's been a huge budget request from the Pentagon to Congress that would support something like the size and scope of a ground troop invasion. So while the rhetoric still tends to be on no ground troops, the actions and sort of the planning muscle behind the White House and at the Pentagon seem to indicate there's at least a robust discussion about ground troops in some way, shape, or form.
Bloomberg Washington Deputy Bureau Chief Laura Davison there this week for us in Hong Kong. Well, meanwhile, investors are bracing for fresh turbulence across assets as the Iran war shows no signs of easing. Let's bring Garfield Reynolds for the market perspective. He, of course, leads our Markets Live Asia coverage. Garf, good morning. Is there a sense that there's some fatigue settling in? There doesn't seem to be a great deal of conviction, particularly for oil markets, even with this dramatic ultimatum.
Yeah, well, Heidi, I don't know if it's a lack of conviction or just an increase in confusion. You were talking about how Trump had gone from saying, we're just about done with this, we can look to wind things down, to we could start bombing infrastructure in 48 hours if Iran doesn't do what we want, with Iran offering some also very firm rhetoric about what they would do should Trump pursue that. So amidst all that, you've got investors coming in this morning. We had an initial pop in crude. WTI went up to as high as 101.50 a barrel in the very early moments. That would have been a response to the clear hardening in rhetoric. It's come back down. It's lost that now, I think, because there haven't really been any headlines that would signal that there is going to be action, or that there has been action so far, to take us to that more intense fighting stage. All the same, you've got Brent above 110, you've got WTI in touching distance of 100. Those are very high levels. That signals not just current disruption, but expectations for these supply shocks to linger. And that sets up a very tough outlook for most other assets, with the possible exception of the US dollar.
So, Garth, in this period now, as we try and ascertain exactly what happens next in the conflict, what are we expecting then? Just low trading volumes and lack of conviction, essentially?
Well, I think plenty of volatility for a start. It was interesting, in fact, that crude volatility readings, that's the implied volatility expectations for price swings, those had calmed down. Then again, they got very, very elevated because you had those extraordinary moves where you would have Brent go to 120, then come back down to 100, and then go back up to 110. So it probably is reasonable to expect a little bit less volatility in crude and a stabilization at around these sort of levels, in which case the pain trades then more go forward to bonds in particular. I think we've had this flip, as you are highlighting, that the traders are now betting on small chances for Fed hikes this year. That's a huge shift from even a couple of weeks ago, still seeing a cut as the next likely move. So that's going to go on weighing on treasuries and on bonds globally. It's also going to go on weighing on currencies, with your dollar strength now building not just on its role as the part of the petrodollar system globally and the world's reserve currency in general, but also that realignment in what's going on with interest rates. So I don't know if it's going to get steady out there. I do think that we're going to get plenty of moves. It just takes one Truth Social post from President Trump or some fresh signs of the conflict picking up, in particular if Iran carries out further attacks on infrastructure in the region. That again could send oil prices climbing or falling if it's a move towards peace, and then that would set up similarly large moves in equities. In particular, I was looking at the S&P 500. We're heading for the worst month since March 2025. And if things get much worse, we'll be heading for the worst month since the end of 2022. So when you've got those sort of extreme declines, you also have plenty of investors who are precisely thinking, when is the time to buy the turnaround? So if they see something that triggers that expectation that this could be, somebody was talking about peak uncertainty, or somebody's going to be talking about peak uncertainty, that's exactly the sort of thing that will get at least some investors to pile in. And then they would also be potentially vulnerable to a rapid reversal if you got a sudden re-escalation after the de-escalation.
With Brent Alton leads our Markets Live Asia coverage. And of course, so much of this global sell-off in equities has been what we've seen in terms of the gains in the US dollar. But one market that we're watching headed for a correction is here in Australia. This is what we're seeing as we see the decline for Aussie stocks of 10% from that March peak. We're now headed for correction territory in a technical correction territory. That is, we've seen 3 straight weeks of losses for Australian equities. We've seen declines of as much as 2% or so just early in the Monday session. So far, we've seen, of course, during this war, some of those energy stocks and that sector being one of the only gainers, but we're even struggling to see much traction for that space. Most sectors in this session declining, financial seeing the biggest losers at this point. We do have monthly inflation data in a couple of days as well, also EU-Australia trade talks to watch out for this week. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're trading, and there's not a great deal of conviction, or perhaps, as Garfield Reynolds alluded to earlier, just a great deal more confusion as we hit the countdown when it comes to President Trump's 48-hour deadline to reopen the Strait of Hormuz. We're just about 24 hours away now in terms of when he hit post on that Truth Social post on Saturday night US time. This is a picture for gold. We're seeing a little bit of an upside there after the worst week in 4 decades. The war risks, the dollar risks continue to mount there. That's a picture for the US dollar index, looking pretty flat at the moment. Of course, that is really one of the key headwinds for what we're seeing in the global equity sell-off as well. Bitcoin seeing a little bit of upside there. As you can see, when it comes to crude, we're starting to see some declines there as that uncertainty continues to play out for oil traders. The Hormuz ultimatum sort of failing to stir direction either way. Let's get some more when it comes to what's going on with the war. Adam Lockyer is the Associate Professor at Macquarie University's School of International Studies. So, given the level of uncertainty, let's just do some crystal ball gazing. What happens 24 hours and about 30 minutes from now?
Well, there's no certainty there, but I can imagine that the Iranian regime is not going to capitulate and give in. They're newly installed, they're hardliners, they're hard men, and they can't be seen as one of their first acts to give in to a Trump tweet. So I think that they're going to hold firm. It then reverts back to Trump, whether or not he's going to taco and Trump always chickens out, or whether or not he's going to follow through on his threats.
This is a regime that's bent on survival, right, particularly at a situation like this. What do you make of how the US wanting an off-ramp, Israel wanting closer to elimination of the leadership and regime change? Is there a middle ground there that ends this war? I
think there has to be a middle ground. That's the only way that this conflict ends. But we keep speeding right past those off-ramps that you mentioned. And so it looks as though that as long as the Israelis continue the bombardment, America has no choice but to be there to support them, and the Iranians continue to retaliate.
Does that end with ground troops?
It depends. I think that the threat of ground troops is more of an instrument of trying to get them to the negotiating table. And if there is some sort of ground insertion, I think that it's going to be fairly limited. We're only seeing 2 Marine units being deployed to the region at this stage. And so the type of level of engagement is going to be more about just securing an island or maybe a bit of the coastline.
I mean, not putting boots on the ground would also follow the standard playbook, or what has become the standard playbook for the US military. What is next, though, given you've already got a lot of key assets that have been taken out?
Yeah, that's the big question, because we've already started to make our way through the United States target list, and now we're starting to run out of targets. And so when Donald Trump is making these threats overnight, he's now looking at these dual-use targets like the Iranian power grid, because what else can he use to apply pressure onto the Iranians? So I think that this now plays more into the Israelis' endgame of trying to weaken Iran as a state, as a continuing threat to the State of Israel, whereas the United States would like to see a strong centralised Iran emerge from this, just with a more friendly government.
Then how do you think about the deadline, this deadline that Trump set of 48 hours? It certainly puts a lot of pressure on the situation, and the only way is for Trump to look at extending it. Do you think that actually becomes the reality then, given how much of a nuclear option it is to take out the key energy infrastructure assets?
Yeah, I think you're right. I think that I don't see that this is going to work as a threat. As I said earlier, the regime itself is new. They're strong men. They can't be seen to be giving in to Trump. So this is going to then go back onto Trump's decision making. He can either extend the deadline, he can just chicken out altogether and say this was just a negotiating tactic, or he needs to follow through. If he follows through, that could be catastrophic, because the Iranians will need to retaliate, and they're threatening to mine the whole of Strait of Hormuz, which is then going to bring China more heavily into the war as well.
Yeah, I wanted to pick up on that point. I noticed that you were talking about sort of the key beneficiaries out of this. Definitely the US and Iran come out on a weaker footing, irrespective of the outcome of the conflict. China, Russia, Israel emerge stronger. Just talk us through exactly how you see that playing out.
Yeah, so I think that Israel's aims here are divergent to the United States' aims. So what Israel would like to see is a weak, maybe even a failed Iranian state, which is going to cease to be a continuing threat to the state of Israel. Now, the United States doesn't want to see that. They would just like to see regime change and a strong state of Iran continuing, which is still going to be able to export oil to the world. So the Russians, they're going to be coming out on top, at least at this stage as well. America is distracted by the Middle East and is no longer focusing on the Ukraine. The United States has already had to loosen its sanctions on Russian oil. And so it's coming out in a much stronger position than everybody else. The Chinese, at this stage, have been able to largely sit out of the conflict. That's seen as the two great power rivals, Russia and the United States, are both embroiled in war, where it can just get on with pursuing its own interests. So as long as there is Chinese oil being able to be exported through the Straits of Hormuz, the Chinese are going to largely stay out of it. So you can see that no matter how this plays out, Iran and the United States will be in a weaker position, whereas Israel, Russia and China look to be coming on top at this stage.
Previous periods of US distraction in the Middle East have resulted in China being able to build up in this part of the world. Are we going to see signs of that increasing? I think we're already seeing signs of that increasing. So we're seeing a lot of Chinese activity around Taiwan. At the same time we're seeing Chinese activity around Taiwan, you're seeing America withdrawing forces from the Indo-Pacific off to the Middle East, which is the opposite to what you'd hope the United States would be doing. When it comes to the economics of war, does this still make sense? And I guess it's interesting because Beijing would be getting pretty good insight into the US defense capability and the economy of how much they have to spend to... Yeah, so it takes a long time to replenish these munitions that are being used in the Middle East. So once again, this is going to be running down stocks in the Indo-Pacific. But as they're running down stocks, we're also seeing a shift in the nature of the conflict, because now the Iranian airspace is far more permissible, which means that the Iranian air defences have been degraded so much that the Americans are using older equipment. So you're seeing these really old A-10 Warthogs, which are these really large, slow-moving aircraft coming in to try and take out Iranian targets. You're seeing the increasing use of Apache helicopters and those type of equipment, which means that the higher-end stuff is no longer being used, partly because that's been used already, but also because they're trying to save that up for other conflicts. Adam, great to have you with us. Adam Lockyer, Associate Professor at Macquarie University School of International Studies. As we're just 24 hours away from the imposed deadline by President Trump to reopen the Strait of Hormuz. More ahead on the Asia Trade. This is Bloomberg. Australia energy stocks are following oil prices higher after US President Donald Trump gave Iran an ultimatum to reopen the Strait of Hormuz, and Tehran threatened more reprisals in response. We are seeing a bit of upside when it comes to trading in oil, not a great deal of conviction as we head into almost 24 hours until the expiry of that imposed deadline. We're seeing the usual suspects, Woodside Energy putting on about 1.5%, Santos there benefiting both from the situation when it comes to the Qatar gas facility being struck, potentially driving LNG prices to $30 according to Bloomberg Intelligence, but also benefiting from that broad shift in terms of structural demand going higher in Asia as well. Santos looking to sell more to Japan and South Korea, along with Woodside as well. So we're seeing both of those gainers continuing to rally despite an overall difficult day for Australian equities and the broader Asian markets as well. In fact, when it comes to Australia, we're headed for that technical correction territory, about 10% since March. This is what we're watching as, of course, we continue to watch the fluctuations on all markets and the latest developments in week 4 of this war. This is Bloomberg. Still just one story when it comes to entering week 4 of this Iran war. We're continuing to watch oil prices. We're seeing a little bit of fluctuation and not a great deal of conviction. An initial small gain was seen, investors really trying to assess so much uncertainty over President Trump's ultimatum to Iran to reopen the Strait of Hormuz. We're just about 15 minutes and 24 hours away from the expiry of that deadline. As he said, it was to that minute of that 7:44 posting on Truth Social. We've seen that reprisal when it comes to the threat of reprisal from Taiwan in response, but we overall have seen that more than 50% gain for the global benchmark since the strikes began in late February. Let's bring our BNEF oil analyst, Wayne Tan. So is this complacency? Is it just confusion? Is it exhaustion for these markets?
Yeah, there's definitely some levels of cautious optimism in there. In about a month from now, the Strait of Hormuz will either be effectively opened or effectively closed. This means that Brent prices will be trading at $80 per barrel or $150 per barrel. So these are two distinct and somewhat binary outcomes. We think that the oil market is leaning more towards the view that the strait will be reopened by a month from now. And given that the US have issued temporary sanction waivers on Russian oil, that gives a bit of relief to the market. IEA member countries released 400 million barrels of oil from its reserves. That amounts to about 3 weeks of demand cover. But we are already into the 4th week of the strait being closed. The good news is that IEA member countries have an additional 1.4 billion barrels of oil in their reserves. The bad news is that that gives us only an additional 10 weeks of demand cover. But the more important point is that most of the oil inventories the world currently has is in crude oil and not refined products like diesel and gasoline. And so the price rally in these fuels have been much more aggressive than crude prices. And the reason why the world has fewer oil products in storage is because it's more technically challenging and expensive to store them. And the production of refined fuels is also more susceptible to disruption. It depends on the entire oil value chain, everything from upstream crude oil supply to midstream pipelines to downstream refineries and shipping. And so if one of those things don't work, refined oil production will be disrupted. And so we are seeing a little bit more panic in the refined oil product markets as compared to the crude oil markets.
Yeah, and fuel prices, of course, have increased significantly. So at what price level do you think that we start to see some sort of demand destruction?
So the key here is, we think that the global economy can absorb a temporary spike in prices, but not a sustained one. So the key here is not just about the price level, but also the duration. So during the Russia-Ukraine war, we saw visible demand destruction at price levels above $90 per barrel. And if prices rise materially from current levels, we can expect to see a real pullback in activities like driving, freight, and air travel. And so if higher prices trigger enough demand destruction, it could lead to a recession. But in the near term, we think that the real impact will be on petrochemical markets, particularly in Asia. So the Strait of Hormuz typically handles about 2.7 million barrels per day of petchem feedstock supply to Asia, and these are barrels not easily replaced. So we expect to see petchem producers cut their operations in countries like South Korea, Japan, Southeast Asia, and China. But the temporary sanction waivers by the US on Russian oil actually helps a little bit because they do produce and export a little bit of petrochemical feedstocks, but it wouldn't even come remotely close to nullifying the entire supply disruption impact.
Well, we've seen energy assets in the Middle East come under attack and continue to be under threat. How do investors feel about these investments now?
Yeah, the risk premium probably extends to other asset classes as well, not just oil and gas. But we think that there are ample opportunities outside of the Middle East in places like Latin America and North America. So countries like US, Canada, Brazil, Guyana, and Argentina comes to mind. In fact, most of the oil supply growth in recent years actually came from countries outside of the Middle East. But we think that this is a real call for countries to diversify their energy mix, particularly on those which are heavily reliant on fossil fuel imports. Even prior to the oil price spike, our annual study on LCOE actually concluded that renewables is actually the cheapest way to meet incremental power demand in virtually every part of the world. And that is with a $60 oil price assumption. So if we were to believe that fossil fuel prices and oil prices remain high for longer, then the economic case for renewables will become even stronger.
Wayne, thanks so much for joining us this morning. That was our BNEF oil analyst there, Wayne Tan. And let's shift to China, of course, because it has been a busy weekend there, the China Development Forum underway. But the Premier, Li Qiang, says the country doesn't seek a trade surplus and will continue to embrace free trade and advance opening up. Speaking at that forum, Li said Beijing was ready to work with its partners to iron out any issues.
We take our trading partners' concerns seriously, and we are ready to work with all parties to promote the sound and balanced development of trade.
Let's go to Beijing and bring in our Chief North Asia correspondent, Stephen Engel. So, Steve, yeah, I mean, this is obviously really getting to the heart of what is a major concern for a lot of economies worldwide. But just to talk us through those comments in more detail and how they're likely to be received as well.
Yeah. Well, he's trying to assuage the fears of trading partners, not just the United States, but elsewhere in Europe and everywhere else, with this congregation of multinational CEOs and chairmen gathered here in the Diaoyutai State Guest House in western Beijing. It is held every year since 2000, when then Premier Zhu Rongji set it up to essentially give the foreign business community the opportunity to flesh out the details that were announced a couple of weeks before at the National People's Congress. And that's exactly what's happening these 2 days, yesterday and today, with Premier Li talking about that record trade surplus. It's not their intention to do that. It was $1.2 trillion, a record in 2025, and exports are surging again in the first couple of months. So he tried to assuage the fears. He didn't mention the war, obviously, in the Middle East by name, but he did talk about these hot spots that are popping up around the world are deeply worrying. And that is something, of course, at the forefront of many of these executives' minds. What is going to be, how long is the war going to last? What's going to be the direct impact on their businesses? Inflation is a big concern, of course, with commodity prices rising. I did talk to the Asia-Pacific head of PepsiCo, Ann Tsai, and she has lots of challenges in the beverage business here in China, but also, of course, in the snacks business. There's hyper competition. There's the involution, right? Price wars, not only in EVs, batteries, and solar. In snack foods, there's been a vicious price war from competitors, local competitors like Three Squirrels. So that's a big challenge. But now the uncertainty, of course, of the rising commodity prices, the input prices of sugar are up, potatoes, other commodities, and of course the oil price shock is another worry for Ann. This is my conversation with her here at the China Development Forum.
Well, it is really a whole ecosystem that we manage with very close partners. We are mostly hedged. We have our facility and our various commodities hedged. And then we also have a very local sourcing program. In fact, 95% of our locally sourced ingredients are done local. And then we also have very solid program that we actually work with strategic partners that we actually manage on a multi-year basis.
How far out are you hedged on certain key ingredients? I mean, I think one of your biggest crops that you buy is potatoes locally, but I mentioned sugar, and then there's the fertilizer. We don't know how long this turmoil is going to last.
Yeah, no, we're definitely watching the situation very, very closely. In fact, we are one of the largest potato grower or partner to our local growers. So we are very confident that we are very resilient when it comes to upstream supply.
Well, we talked broadly about innovation that you've implemented, but how specifically do you use AI?
We use AI in every part of the value chain, really. I mean, if we think about at the very upstream agro, we use tech to help us do precision agriculture. So the irrigation, the fertilization, all this will be done with precision using AI to help us to track the crops. Certainly in the factory, we're using AI and digital twins for us to drive precision, quality, and then obviously productivity in the value chain. We're using AI to help us scout consumer new trends, social listening, and then we're using AI to help us create and mass edit and mass customize our consumer material as well. So it's done every part in the value chain.
How about with manufacturing, though? It helps with efficiency, but does that mean fewer people?
It is not absolutely fewer people, but it's actually the people are being upskilled and then they are deployed across more facilities. Remember, we have 5 manufacturing plants in China over the last 5 years. We were able to service these plants without having to add a whole lot of people, but then at the same time, we are actually upskilling our folks.
Are you going to be adding more factories in China or just making those existing 5 more efficient?
We will be making the 5 more efficient for the short time because it is quite a bit of capacity that we added over the last couple of years. But the market is huge, so we will be adding more in the future as we see the demand shore up.
And it's going to be another busy day here at the CDF in Villa 14 in the Diaoyutai State Guest House. A lot of top executives from around the world are here. Tim Cook gave a speech yesterday from Apple, of course, and then Sergio Amati, the UBS CEO, will be joining us later on Bloomberg Television to talk about his impressions of CDF. And I'm going to be looking for the U.S.-China Business Council head, Sean Stein. Apparently, U.S. businesses met with He Lifeng, the vice premier who leads China's negotiations on the trade front with the United States. They met at the Great Hall of the People last night, so I want to get his take as well. Hopefully, Sean, if you're watching Bloomberg TV, come find me.
Some great conversations ahead. Our Chief North Asia correspondent, Stephen Engle, there with us. Our coverage, of course, as Steve mentioned, of the China Development Forum continues today. We'll be speaking with the UBS Group CEO, Sergio Amati. Fortescue Metals CEO, Dino Otranto, will be along with us on the China Show.
Yeah, Haidi, great lineup of guests. But the top global headlines we're tracking this morning as well. The US is deploying immigration agents to airports. That's to help ease delays caused by a budget impasse. The border chief, Tom Homan, says the agents will perform non-significant tasks and won't be using X-ray machines or scanning luggage. TSA employees have gone unpaid for 5 weeks. That's due to the partial shutdown, leading to lengthy delays at US airports.
We're simply there to help TSA do their job in areas that don't need their specialized expertise, such as, screening through the X-ray machine. Not training that, we won't do that. But there are roles we can play to release TSA officers from the non-significant roles, such as guarding an exit, so they can get back to the scanning machines and move people quicker. And we're just simply helping our fellow officers at TSA.
A senior Cuban official says the country is preparing for a possible military assault. The deputy foreign minister made the comments to NBC News. That's as President Trump increases economic pressure on the government in Havana and suggests it could be the next US target after Venezuela and Iran.
Our military is always prepared, and in fact it is preparing these days for the possibility of military aggression. We would be naive if, looking at what's happening around the world, we would not do that. But we truly hope that it doesn't occur. We don't see why it would have to occur, and we find no justification whatsoever. Why would the government of the United States force its country to take military action against a neighboring country like Cuba?
We'll have more ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade this morning and taking a quick look at how currencies are faring. We are just seeing really, we have actually seen broad dollar strength, of course, and investors really piling back into that asset. It's having a bearing on a lot of different other classes, including, of course, what we see across other FX peers, but then also what's happening in the equity space, moves in treasuries, and coming back down to that energy story as well. But let's get more on where currencies head from here. Bring in our Bloomberg Intelligence Chief Asia FX and Rate Strategist, Stephen Chu. So, yeah, I mean, it has been that story of dollar dominance and it's extended. So how does that set us up going into this new trading week, given that we've got the conflict as well into its 4th week as well?
I think the dollar strength is super interesting. A lot of people talk about the dollar is back, now it's the best safe haven. But I think one point that people miss is if you look at the positioning entering this J market was net short the dollar. And the latest data last week showed that now we are seeing a dollar net long, meaning that it's a positioning adjustment that caused the dollar strength. There's also an liquidity element as well, because usually when we have a risk-off scenario, the gold rally, but the gold actually factored because of the dollar strength. So for now, the dollar strength will stay, especially given the uncertainties about the Iran war situation. But it doesn't mean that the dollar is going to strengthen and rise forever, because at the end of the day, this is a U.S.-centric event. So market may come back just like last year, just like the second quarter of last year. They could short the dollar if this drags on.
What is the impact? It's not even, is it, across Asian FX?
I mean, at the beginning of the year, we were saying there are a lot of uncertainties, and regardless of the dollar trend, it's better to pick the currencies that are more isolated for the strong greenback. Our favorite pick is still the Chinese yuan, the Malaysian ringgit. Now, these are the outperformers so far, despite the dollar rally. And you want to avoid the currencies right now, especially that are net oil importer nations, talking about the South Korean won, the Thai baht, obviously Indian rupee, Philippine peso. So these are all the currencies that have been quite weak even before the war broke, and now even more so. So you want to avoid those currencies. They're going to stay under pressure.
And how does that also factor into the rate story as well? Because we've seen really changing expectations around not just what the Fed may be forced to do, but also a lot of central banks in this part of the world.
Yeah, usually for central banks, especially in Asia, they will overlook if it's a supply-side shock. And this time, obviously, it's a supply-side shock. The problem is nobody knows how long the war is going to drag on. And given some facilities of these oil output countries, it's being disrupted. Prices could be stickier in terms of higher oil prices. So they have to care about it. So even though if they can't hike right away, they have to stay hawkish and manage market expectations. So we can basically see rates being supportive, especially in the short end, across the Asian curves.
Yeah, and you're really seeing that, I guess, even just there in Aussie yields that are all moving higher here. But that was our Bloomberg Intelligence Chief Asia FX and Rate Strategist, Stephen Chu. And let's take a quick check on what's happening in the equity space, because, yeah, interesting moves that we've seen in the Korean won and really sliding against the dollar. And you're seeing that also perhaps having a bearing on the equity picture. But you've got the likes of Samsung, SK Hynix that are really slumping to start the week and setting the tone of what could be very much a risk-off day across Asian equities. We do also have some local media reporting that levered ETFs could be debuting later in the year. Of course, investors, these have been it's the Kospi 2 story essentially on these names. But more ahead on the Asia trade. This is Bloomberg.
Westwood Capital founder Martin Sorrell says investors are not yet fully pricing in the impact of the Iran war. Speaking to Bloomberg, Sorrell says that prospects for a longer conflict are rattling the executives that he's been speaking with.
Depends on how long it lasts. I mean, if it lasted 3 or 4 weeks, maybe limited damage. But if it goes on any longer, I think quite significant damage. I was on a call with a few CEOs about 24, 48 hours ago. A lot of worried people, because the markets to date have really underestimated. I mean, maybe on Friday we saw some more realism creeping in, but
so there's more pain in the S&P.
Well, there should be, I think, in theory. I mean, the number of people on the call I listen to, and I'm looking at stuff that's more publicly available, I think the general view is the markets have underestimated so far. They're betting on it being a 3 or 4 week war and not lasting much longer beyond that. But it certainly doesn't feel like that. The off-ramp, I hate that phrase, but the off-ramp is not a clear one. I mean, we're here in China. Some people posit maybe the Chinese can act as a diplomatic help.
They've resisted that. I mean, they've resisted sending, obviously, any kind of military aid to the Straits of Hormuz.
I was referring to diplomatic intervention or help, but it doesn't sound as though they're keen to do that either. So
they want stability too. They're not necessarily. Would you feel that the Chinese are saying, "Yeah, this is our advantage here"?
I don't know whether they're saying it's an advantage. I think it's probably a disadvantage. I mean, their dependence on oil is significant.
Diplomatically, though, I mean, obviously, the whole world gets
oil shock?
Well, I mean, just from a personal point of view, I think, diplomatically it would be good for China to be seen as the opportunity, or grasping the opportunity to try and develop a political solution, a diplomatic solution. So I think it's in their interests economically and, dare I say it, politically, to be seen to do that, as a force on the international scene, as a peaceful force on the international scene. I'm not talking about military intervention or anything like that. We have to see how this pans out. It's so unpredictable. And going back to your fundamental question, the one thing we don't need is this uncertainty. I'd rather dribble along at a lower growth rate with some certainty than have this volatility.
Sounding like the Chinese government a little bit. That's kind of, you kind of get Li Chang saying the same thing, right? Look, they're consistent in messaging.
Yeah. No, I think the uncertainty. I mean, we've moved into a different age. You and I have talked about this for a number of years. I mean, the golden age of globalization probably over. Fragmentation. You've got U.S.-China relations is an issue. You've got, and obviously the postponement of the meeting, to my mind, is not a good signal.
S4 Capital founder Martin Sorrell there speaking with our Bloomberg Chief North Asia correspondent Stephen Engel at the China Development Forum in Beijing. Let's get you caught up with some of the corporate headlines that we're following. And Goldman Sachs has boosted pay for its top executives, including its CFO and departing general counsel. The investment bank raised President John Waldron's compensation for 2025 by 18% to $45 million. Departing general counsel Catherine Rumler received an 11% raise. Goldman reported bumper financial results last year, fueled by record trading and banking revenue. Bloomberg's been told that Fannie Mae and Freddie Mac have begun placing sizable orders to purchase mortgage-backed securities amid a surge in volatility. A source says US government-controlled entities are moving to capitalise on a sharp sell-off while expanding their portfolios of bonds and loans. In January, President Trump instructed the companies to acquire $200 billion of MBS.
Quick check on how markets are faring. We are just heading into the opens here for Japan, South Korea. You can see there's going to be quite a bit of selling pressure at the open that's expected. Nikkei playing catch down, given it was also shut on Friday for trading. The Kospi here, we've already seen the likes of SK Hynix, Samsung off by around 4%. The ASX 200, of course, the other market that we're tracking today, given it's headed into technical correction territory. But certainly it is that dollar strength story. We're seeing yields that are rising. The Iran war heading into a fourth week. More ahead. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens. We're heading into the session today. Lots of volatility certainly expected. And the moves that we come into the session today, of course, you've got President Trump's ultimatum, a 48-hour ultimatum. We're roughly around that halfway point. What exactly happens next is the big question.
Yes, does he find an off-ramp? Does he extend that deadline? Nobody really knows. We know that risk of reprisal has already been drawn out by Tehran. But we are getting, as you say, quite a bit of uncertainty and also just repricing around oil price expectations, right? Goldman's coming out with it's hiked the 2026 Brent forecast on the Hormuz disruption, hiking that 2026 Brent forecast price to $85 a barrel from $77, assuming that Hormuz flows 5% of normal level for 6 weeks. So we will see what happens in less than 24 hours' time.
Yeah, that's right. And in the meantime, though, of course, it has been that story of dollar that's energy that's moving higher. You've seen that reflected, for instance, in the Aussie session so far, dollar strength, and that is putting pressure as yields rise on what happens with stocks as well. So you've got the Nikkei just coming online this morning, 1.7% to the downside. Of course, we'll wait for that to be fully reflected with all stocks coming online today. We were guiding for a loss of around 4% at the start of trade. The story, of course, around Japan particularly, we had markets that were shut on Friday. So, again, really catching up to some of those gyrations over the past 72 hours. Let's also take a look at what's happening in Korea this morning. we do actually see the Kospi again coming online to the downside here. A 4% loss. We're seeing that reflected in names like SK Hynix, Samsung, for instance. We did actually just get the 20-day trade data coming out. I think it's notable, just given you've continued to see that strength, and it does come back into the tech story, of course, given that we've seen very strong pricing power for HBM, but also legacy DRAM products as well. So we've seen exports rising 50% in the first 20 days of March, even against that backdrop, Haidi, of course, of what is the Iran war.
And so much as this is really causing quite a bit of chaos across treasuries and sovereign bond pricing, right? We are seeing treasury futures following Aussie bond contracts lower. Also a big move when it comes to Kiwi yields as well. That Monday sell-off in Australian bonds really driving what we continue to see is treasury yields contracts making new 2026 lows. We had a sharp decline on Friday as well. So yields there in the US are the highest in months, a third straight week of bond losses. That surge in oil, such a big part of the story. Let's bring in our Martin Schulz, who's the head of International Equity Group at Federated Hermes. Really great to have you with us, Martin. So what do you make of the trading dynamic at the moment? Clearly, we're still seeing reacting to headlines. Is it less of a reaction than you might expect, though?
Good morning, Haidi. Thank you so much for having me. Yeah, I think the markets are definitely getting more nervous about what's going on in the Middle East right now. But our view is that it's a time for caution, not panic, particularly as it relates to, for example, our PRISM committees at Federated Hermes. We're looking at, obviously, a lot of other factors out there: private credit, AI disruption, renewed tariff uncertainty, inflation. And this is obviously just another brick in the wall of worry, so to speak. So from that perspective, we do think the volatility matches historical geopolitical events in the last 30 or 40 years. Time will tell. Obviously, duration is the main issue. The longer this drags out, the worse it gets. And it's all about the price of oil and the supply chain and how that all plays out.
There's so little visibility, as you point out, and we've now got this ultimatum by President Trump. We know what the risk of reprisal is from Iran if this plays out, as a worst-case scenario. So what do you recommend investors do at this point?
Well, it's tough, right? If you were long oil going into this event, you're probably at some point in time going to take some money off the table. If you've been smart enough, maybe on the margin, to take some risk off the table for economically sensitive sectors and that sort of thing, and/or you've gotten out, on the margin out of Europe and some of those regions that are most affected, I'd say you should be at least devising a medium long-term plan on which stocks and regions you think will because obviously as we see this volatility hit the markets, high-quality companies are being sold off, and we think it's an opportunity. And so from that perspective, we do like Latin America. We like actually consumer plays potentially, again, depending how long this drags out. And we also, believe it or not, like Japan and South Korea for the mid and long term, because they do have some structural factors that will lead to higher market activity in those regions.
Just on that point of what we're seeing with Japan, because we've got trading starting to be a little bit more fully reflected as we see all stocks coming online this morning for the Nikkei 225. But so far, a drop of around 3%, Martin, on that index. I do also want to get your views on Korea in particular, because we just had the 20-day trade data coming out and still showing a lot of strength at the start of March, even against this backdrop of the Iran war. That tech story still seems to be intact, even against the backdrop of this risk of an increase in inflationary pressure. How long do you think that stays the case?
Well, that's a great question. I think you're highlighting some really important data. We were going into this geopolitical event, if you will, fairly in a stronger situation, right? Inflation had been coming down the last few years. The labor market was already somewhat weak, but at the end of the day, global economic activity was actually starting to ramp up. You've got the big, beautiful bill in the U.S. You have some pump priming fiscally in places like Japan and in China that were helping things. And so, this AI story that particularly that Korea is a big part of, we think is going to continue. But to your point, again, I think if you look back at the Iraq War, early 90s, all through the more recent past, generally speaking, it's that 4 to 6 week period when you're going to hit the heightened area of uncertainty, and that's kind of what we're in and entering right now. And so,
yeah, I love
to your
that.
question, yeah, sorry, duration. If the oil price stays above 90, that's going to be deleterious to economic activities. It's going to be demand destruction. We don't think we're there yet. As you mentioned earlier, Goldman Sachs just increased its oil price. Oil was actually going into this a deflationary force into the economic realm, and now it's going to potentially be a headwind. And so, yes, if we're still talking about this 3 to 4 weeks from now, and oil is above 90 or even over 100, then I'd say we definitely would. I think the markets will then have to readjust accordingly.
Yeah, I found the point you were making around historical precedent really interesting, and saying that week 4 could be sort of a peak period of uncertainty if you go back to conflicts all the way back into the late 90s. But do you take this then as a buying opportunity if you're saying that this is actually the factors that were already in play ahead of the Iran conflict could actually be the same factors exiting out of it as well?
Yeah, no, timing is always a difficult, when, as they say, when there's blood in the streets, you should be buying. I'd say we're closer to an end, if you will, to this uncertainty, higher volatility, and higher oil prices. But obviously, events on the ground, this is what makes forecasting in this arena so difficult, because the news cycle is so quick, and obviously it affects market sentiment so quickly as well. But we do think on the margin, we started to dip our toe in on Friday here and there, because we do think, Friday was kind of unique because quadruple witching hour and a lot of other factors in play. But we do think that near-term volatility will remain high. But in the next week or so, if you've got some high-quality stocks that you've been following that you like, particularly those in Latin America, in the consumption space and healthcare, they're probably stocks you should be at least dipping your toe and buying in at this point.
Martin, great to have you with us this morning. That was Martin Schulz there, head of International Equity Group at Federated Hermes. And taking a quick look at how we're faring so far. We're just under 10 minutes into the session so far. It's a sea of red across the screen here. You can see that really a lot of losses, particularly in the materials sub-index that you've got, but Japan really bearing the brunt so far as well, as we get it coming back after a long weekend holiday. The Kospi nearly 5% in the red as well. But more ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade and taking a look at how Brent crude is faring this morning. It is really one of the few assets that's moving higher. We see a sea of red across the broader markets today. But again, that energy story very much in play. And Goldman Sachs, to that end, has just raised its 2026 Brent forecast to $85 a barrel. That's up from 77, and of course coming back down to what we're seeing in the Strait of Hormuz and the disruptions there. But on that point, the US Treasury Secretary Scott Bessent says the US is in control of the Iran war. He told NBC that the US and Israeli attacks on Iran are aimed at destroying its fortifications along the Strait of Hormuz.
Every day, we are taking out their missiles, their missile systems, and the factories that build those missiles. And now the General Kane, Secretary Hegseth, are leading a campaign to destroy all the fortifications along the Straits of Hormuz. Again, they're not mutually exclusive. Sometimes you have to escalate to de-escalate, Chris.
Let's bring in our Washington Deputy Bureau Chief, Laura Davison, joining us this morning. So, Laura, we're coming up to around that halfway point of this arbitrary deadline, essentially, that President Trump has put in place for Iran to open or reopen the Strait of Hormuz. What's the likelihood, though, that we see Trump taco, essentially?
The likelihood here is relatively to medium high here. It is very unlikely that Iran is going to capitulate. Every sign that they have said, is that they are going to continue to launch retaliatory attacks, as well as that, that there's been internal reports from the Iranian government that they are not discussing at all reopening the Strait of Hormuz. That is sort of their ace card. That's the leverage they have in this situation. So there's no incentive for them to go ahead and give in to this demand. This is a classic Trump move here of set a deadline, an arbitrary deadline for something and then potentially extend it or have some other sort of workaround, claim victory in one area and move to somewhere else with this 48-hour deadline. You know, it's one of the things, you know, sort of what he said here is that he's going to attack energy sites in the region in Iran. That will only further increase likely energy prices, which is sort of the opposite of the goal that he wants with Hormuz. So he's kind of puts himself in this tricky pretzel where he's, you know, trying to both calm markets and domestic audiences by saying on Friday this war is winding down, but also really upping the ante with Iran, you know, just hours later.
Yeah, it's interesting that pretzel analogy, but who put Trump into this pretzel? Is it Trump or is it Israel as well? Because the idea of taking out key Iranian energy infrastructure seems to be something that would be more amenable to what Israel wants to see versus what the U.S. actually wants to see.
This is a huge question right now. You know, there's no question that Trump, you know, got himself into this this predicament. But kind of who are the voices that are influencing him most, you know, are very important right now. In a traditional cabinet, you'd see, you know, different people sort of weighing in saying, look, you know, here are the pros and here are the cons of the situation. With Israel, our reporting shows that it's really sort of only the cheerleaders are the vocal voices. So folks like Netanyahu, Rupert Murdoch also weighed in, conservative commentators in the U.S., and then the people who were more on the, you know, kind of worried about moving into Iran were silent versus expressing that opposition. So that's why Netanyahu has had really outsized influence over Trump in this situation because he's one of the trusted voices. This is obviously a goal he's had for a long time. He's been able to get Trump to go along with this. Trump, though, has been eager to make it seem like Netanyahu isn't driving the ship. He, you know, a couple weeks ago said that, look, it was my decision, perhaps even myself, I pushed Israel into
Force
this.
their hand, yeah.
But this is, you know, been sort of, you know, sort of him trying to manage the optics here.
What's the domestic situation looking like? It's so curious, right? As we inching closer to summer driving season, pump prices are going up. How much pressure is he under?
He's under a lot of pressure domestically. You know, just as, you know, oil prices are up, you know, almost $1. They had been sort of under $3 for many months. You know, as we're headed into both spring break in the U.S. as well as summer travel, a lot of airlines have started putting on these fuel surcharges. This is all going to be bad news as Republicans look towards the midterms in terms of affordability and the message that they want to, you know, convey to voters that they are, you know, making life easier and lowering prices. You know, even now we're at, you know, almost at the 4-week mark in this war. A lot of analysts are saying that even if, you know, kind of the fighting were to stop today, that there would be a long lag time for our energy prices to return to what they were before the strikes. This means that, you know, Republicans are not going to be able to avoid this into the midterms, and this is going to be both a, you know, sort of policy question on the U.S.'s role on the global stage, as well as affordability that Trump and Republicans are going to have to answer for at the polls.
Our Bloomberg Washington Deputy Bureau Chief Laura Davidson in Hong Kong this week with us. Well, Chinese Premier Li Qiang says China does not seek a trade surplus and will continue to embrace free trade and advance opening up. Speaking at the China Development Forum, Li said that Beijing was ready to work with its partners to iron out any issues.
We take our trading partners' concerns seriously, and we are ready to work with all parties to promote the sound and balanced development of trade.
Let's head to Beijing, bringing our Chief North Asia correspondent Stephen Angle. And it almost feels like trade imbalances, if you will, have taken a backseat in terms of global headlines, but still top of mind when you take a look at these numbers.
Yeah, that's right. So Li Qiang was pretty consistent in his messaging, and I think that was pretty deliberate to essentially say, hey, global CEOs and chairmen gathered here at the Diaoyutai State Guest House. We are a reliable partner. We are opening up. We are rebalancing. Never mind this 1.2 trillion record trade surplus in 2025. We are rebalancing. We are opening up to more imports from abroad from your companies. Tim Cook was here and other big heads of multinational companies listening to this pitch following, of course, about 3 or 4 weeks after the unveiling of the 15th five-year plan at the National People's Congress, where indigenous innovation, AI, and building out services and opening up further were the hallmarks of that next 5 years through 2030. Now, shortly after this speech with Li Qiang, I caught up with Joe Ngai. He's the Greater China head at McKinsey, and asked him what stood out to the speech to him.
I think what's the most remarkable at the CDF is how unremarkable the messages are. If you have sat here for the last 2 years, the message is the same one, right? It's around China's open for business. We're 30% of global growth, right? And if you come here, and today we heard for the first time, Premier Li Qiang was talking about China as a gym where companies are training up their muscles. And I've been saying that we are in the world's toughest gym here, right? This is where, companies find it difficult, but at the same time, if you survive, right, you can thrive anywhere.
You're also seeing companies, multinational companies, Western companies coming back, dipping their toes back in the water after a few years of skepticism and getting punished back home guilty by association. It's different now, isn't it?
If you look around here, I think that you're having the best attendance, right, of CDF. And if you look at even last year, the amount of tourists and business travel to China is at an all-time high. So if you look at what is this renewed interest, I think it's a little bit of this acknowledgement that this is a market we can't miss. This is a market where innovation is happening. This is a market where it's a little bit too big to ignore. It's a market where, to be honest, for them, it also represents a lot of the future. So if I look at the business conversations around, a few years ago, it was like, is China investable? Right now, the question is, like, how do I invest that I can actually make it better for me, for the rest of the world?
What do you tell your clients when they ask that question? Is it investable, or is there still that risk? There's always risk, I know. China is always there's a risk premium as well. But
I give you one example. In the last 3 weeks, as the world goes into a lot of turmoil, I see a lot of Chinese clean energy companies, wind power, solar companies are looking at this saying that we are seeing interest in us, not just because of sustainability, but because of resilience, right? What China has been doing in terms of like its clean energy and the different sources of energy, renewable energy, I think is really something that actually everyone looking at as an example of what perhaps we can do. One more example, right? I think that China in the last few weeks have now become the biggest exporter of tokens. So the next export from China, you can't tariff it. It's going to be tokens. So it's quite interesting how when people come to China these days, it's looking a little bit into the future and looking a little bit into what can that help us in our country advance our own agendas. And I think that's very different than before, where it was around, can I sell more in China? Can I make my China business bigger? I think the mentality is now very, very different.
How do you see the oil shock affecting this economy? Because they've been trying to get out of persistent deflation for 4 years at the factory gate. This could kind of kickstart them out, like Japan saw that as well, kickstarting, fuel-led inflation. But again, is it the right kind of inflation? It's cost-based. It's not demand-based inflation.
I think like many economies around the world, I think China is dependent, right, on oil. I do think that it's a shock to everyone, but at the same time, I do think that I look around, in the China economy and the industrialists around. I think people do think that China also has many alternative energy sources. I think that China has been actually building, right, a lot of these over the last couple of years. So I would say that the resilience, right, of the industry in China is something where people are confident about. Will that lead into a little bit of price increase? Absolutely. Is that a bad thing? Maybe not.
So obviously resilience, energy sufficiency, and resilience obviously at the fore of thoughts here, even though Premier Li did not necessarily mention by name the war in the Middle East or Iran. He did talk about hotspots emerging that are quite worrying. And he also essentially said that China will continue to embrace free trade and advance opening up. He did mention that there is a game of power politics running rampant around the world. We have many more interviews coming up on day 2, the final day here at the Diaoyutai State Guest House in Western Beijing.
Those conversations coming up with our Chief North Asia correspondent Stephen Engle there on the ground. And as Steve mentioned, some of those chats that will be happening today will be speaking exclusively with the UBS Group CEO Sergio Ramotti. Fortescue Metals CEO Dino Otranto will also be joining us live on the China Show. More ahead on the Asia trade. This is Bloomberg.
You're watching the Asia trade this morning, and risk appetite is absolutely souring. You can see here to start the week, kicking off what we're seeing in Korea, for instance, where you've got the likes of Samsung SK Hynix facing a lot of pressure. So what's happening is that investors are pricing out Fed cuts for this year, replacing them with hike expectations instead. And then adding to that, you've actually got the BOK governor also who's going to be shifting from May, and it could be a faster tightening cycle that gets underway as well. So we have seen South Korean stocks briefly halted, just given the drop that we're seeing in futures that you can track there. But let's also take a look at what's happening in Japan, because again, it's a similar story. We've got Japanese equities that are coming back after an extended break, and we are seeing lots of losses here across the screen, yields that are moving higher, and we have as well seen that dollar strength story continuing to play out over several weeks. Really, it is that dynamic of stronger oil prices, stronger dollar prices, yields that rise, and that puts equities under pressure too, Heidi.
So much going on, Belle, and so much uncertainty and lack of visibility for investors. And we're also tracking some of the other headlines at the moment. And the US is deploying immigration agents to airports to help ease delays caused by a budget impasse. Border Chief Tom Homan says the agents will perform non-significant tasks and won't be using X-ray machines or scanning luggage. TSA employees have gone unpaid for 5 weeks due to the partial shutdown, leading to lengthy delays at US airports. A senior Cuban official says the country is preparing for a possible military assault. The Deputy Foreign Minister made the comments to NBC News as President Trump increases economic pressure on the government in Havana and suggests it could be the next US target after Venezuela and Iran.
Our military is always prepared, and in fact it is preparing these days for the possibility of military aggression. We would be naive if, looking at what's happening around the world, we would not do that. But we truly hope that it doesn't occur. We don't see why it would have to occur, and we find no justification whatsoever why would the government of the United States force its country to take military action against a neighboring country like Cuba.
Take a look at how we're shaping up for Europe, given risk appetite is really not much of it at the moment as we continue to count down to President Trump's imposed deadline to reopen the Strait of Hormuz. We know that Iran has already threatened reprisal if this plays out in the worst case scenario. But this is a picture as we see Euro Stoxx 50 futures already down by 1.1% there. This pain trade is really permeating everything from Asian equities across to gold and to other global equities there as well. Global stocks are really some of the hardest hit. We've seen European stocks dropping across a previous session again as this Iran situation boosts energy prices. Investors also shifting their attention from oil to the situation with natural gas as well. We are looking at DAX futures softer by 1.3% there. That's a picture when it comes to trading in euro dollar. The dollar pain trade is really the one that we're seeing having a massive impact that had been such a tailwind for global equities, and that is now really seem to be reversing. Much more ahead. This is Bloomberg. Take a look at what's already been a volatile session so far for Korean assets this morning. We're just about 30 minutes into the start of trading. We already had the halting of the Kospi program trading as futures dropped to 5%, really triggering that so-called sidecar mechanism to ease market volatility. We are seeing quite a bit of volatility still at the moment with the Kospi trading down at 4.9% there. The Kosdaqs are slightly better, if you can kind of put it that way, 3.7%. We had another strong set of numbers from those 20-day exports when it comes to chips exports, really showing that resilience despite the ongoing geopolitical turmoil there as well. Surging energy prices, renewed trade uncertainty, overall clouding that global demand picture, and of course that really impacts the likes of the South Korean economy in a bit of an outsized way. Well, in the meantime, when it comes to the Bank of Korea, we've seen a nomination for Shin Hoon-song as the nation's next central bank governor. The senior BIS official will be steering monetary policy at a time of enormous growing uncertainty due to the geopolitical situation. For more, let's bring in Bloomberg economist Hyo-sung Kwon. So what do we make about this nomination and the implications?
So I think the President Lee Jae-myung's nomination of Hyun Sung Shin as the next BOK governor signals the commitment to central bank independence and credibility, especially at a time when external risks is raising inflation and FX risks. Shen Songxin, as mentioned, that is a renowned economist, currently head of economic research and PIS economic advisor. He has advocated of a central bank independence and credibility.
What do you think it means for the pace of what now looks to be tightening, really, for many central banks here, but also the BOK in particular?
I think Shin is a pragmatic hawk who is willing to take preemptive action to contain inflation and unwilling to look through financial imbalances. But he also likes to flexible approach, as you mentioned, that at this recent oil price shock, central bank should look through this shock if inflation is temporary. But overall, I think his nomination, or if it confirmed, will raise the risk of faster rate hikes for the BOK than market currently expect.
What about the fiscal risks? What did we see as the impact on a supplementary budget?
Yes, the Korean government announced that it will introduce a supplementary budget of the size of 25 trillion won, which is slightly less than 1% of GDP. We don't know yet when it will be passed. It will pass the National Assembly and how it will allocate. But I think under the assumption that it will be allocated to transfer payments to households and oil refiners to compensate their loss from the fuel price cap, it will raise GDP growth by 0.1 percentage point this year. But it is important to see how Shin will assess the current fiscal stance, because he argued that monetary policy should not ignore its impact or influence on fiscal stance, and also fiscal authorities should take care or be careful because expansion in fiscal spending will lead to higher interest rates.
We just hold that thought, actually, Hui Sung Kwon there, the Bloomberg economist, because we do actually need to also mention the market moves, as Haidi was referencing it. We've seen quite large gyrations, really, so far in the session today. Even a sidecar mechanism or a market halt being implemented just to try and stem what has been some quite big moves. But you've got the Kospi here today off 5% so far, and again, it does cut back down to these events in the Middle East, but also the expectation around what that is going to have in terms of energy price effects, then also inflation expectations as well. And this thought that perhaps we do see further tightening coming from the BOK, especially with the new governor that'll be starting in that position in May of this year. So just taking a look at the Korean won, you're trading around levels not seen since 2009. But a lot of pressure on names like SK Hynix and Samsung so far today. That was our Bloomberg economist just joining us there. But let's also shift over to what is happening at the Milken Institute with the annual Global Investors Symposium beginning in Hong Kong today. It brings together business and investment leaders to discuss how shifts in capital flows and regional growth are reshaping investment strategy across Asia. Let's cross over to the event where our China correspondent Min Min Lo is with our next guest.
Thanks, Belle. It's certainly been a busy morning here at the Four Seasons Hotel with Iran making so many headlines. And let's bring in our next guest, Perry Wong, the Senior Fellow and Managing Director at the Milken Institute. Perry, great to have you here with us.
Nice to be here.
Yes, so we have seen a lot of market volatility, no signs of de-escalation in the Iran war. There are now fears of inflation and a global economic slowdown. What are the implications on China's growth, given it's so reliant on exports as well?
I think China, as one of the large economies, not just China, but all economies, but the larger one depends on energy tremendously. So with the up and down of the market, coupled with uncertainty, I think up and down itself is not a big issue, but the unanswered questions on how this ends and when this will end, I think would affect the market continuously. I think let's just play it out as, say, if we solve the problem today, So war cease to exist and people start to talk. Even if we enter on that stage, the market will still kind of watch. The perceived risk sometimes is affect the economy even more, or can be more, than the actual risk. I think because people just don't know. Business operator cannot run on, say, unpredictable future, because then where to park the capital? That becomes a huge question.
So, given the current scenario, where do you think realistically China's growth will fall this year, between that 4.5% to 5% range?
Well, I think the new targets reflects on a couple of realities, if you will, that either some Chinese government can manage and control or contain, but others China cannot. Just like business flow, no one country can say, I dictate the growth rate, I dictate the flow of capital. So in that, the Chinese government accommodate for the external risks and also look at some of the structural reform that the Chinese government, I think the 15 5-year plan, they laid it out. So they go accordingly. So internally, externally, they try to take a balance. And if you look back in the Chinese government's planning, this is one of the 5-year plan that could be more balanced with some focus, but anticipating risks that beyond their control. So it's a fun plan to read. So they put a zone at 4.5 to 5. With the 4.5, it says, right, even if the economy grow at 4.5% by, say, 2030, 2035, some would take the extra 5 years, that the growth target would pretty much go with their own planning and their targets. So they could give this lower bound and higher bound to just reflect upon uncertainties.
So some economists believe that China's PPI, which has been in deflation for 3.5 years now, I believe, some say it can flip to positive even as soon as this month, given the energy shocks. Do you think that's realistic?
Possible. That's possible. I think the question is it possibility? But if you look at China's growth planning, they would rather go for quality growth than quantity growth. And that is not a slogan, because they do have to address on several of the fundamental issues that have been, if you will, dragging the growth behind or below expectation. Not just the nation's leaders' expectation, but the business person and broadly speaking, people. So they would expect the economy would do better, and they hope that the economy would do better. With that in mind, we cannot expect the economy grow substantially beyond and say, all of a sudden, the contraction will turn hugely positive. I think if you can run a balance, say their target is 2% on the pricing increase, which would be more in line on most of the major economies around the world. So everyone targeted 2%, but sometimes it's not that easy.
How much concern is there that the energy inflation is going to lead to a negative feedback loop on consumption, because it's not necessarily demand driven, it's cost driven, right? And it could squeeze on corporate profits again.
It can get out of control. But I think so far, if you look at, this is a funny thing, if you look at the Chinese government, they have been trying to build up their oil reserve, I think in anticipation of, say, not necessarily war, but just say trade friction with some economies, some countries. So they would try to protect their supply. It's the energy and foodstuff that the Chinese government have taken a 3 to 5 years planning looking back. So now their reserve is pretty high. So I think if you go by some energy specialist forecast, they said, well, the Chinese economy can take perhaps 16 months or so, maybe even longer, given the energy crisis, coming, they can actually sustain their domestic production.
How big of a hit do you think China's exports will be affected?
it would be a big hit, but how much is hard to tell. Because if you look at China's export, a huge part of that is what I would call stable products, meaning people have to replace non-durable consumption items. They are not, say, $5,000, $2,000 items. Perhaps they are $5 items, $10 items. And those I don't think would be affected so much. Now, the production cost is high, but then the profit margin is really so thin, and they have the supply chain, some of them move to other countries in Asia, and some of them in Africa even. So the cost is not necessarily burdened totally on the Chinese economy. So if you take the other side of it, say the higher end products such as the EV, and that takes a lot to produce. But then the market is opening up to the Chinese producers, say Australia, Canada even. So you have new markets, and Europe. Now that I think would help the Chinese export still. So if you look at the up and downside and upside, I would say the risk is there. It would hurt the production and export, but then at least it's not going to be so detrimental in other ways.
And last week was a big central bank week. We have most central banks holding rates. Does that change your forecast of the scale and pace of rate cuts from the PBOC?
Not necessary, because I think there are factors that the Chinese government have to pay attention to. It's not just external, the internal. They want to engage in some reform, and which is a big promise, because they know that they have to dig deep, into some of the root cause of some of the problems that plague the Chinese economy, such as property sector, and also such as what they call nature. So the ultra competitive operation in China, no one makes a profit. They want to clamp down on that. So all those have to go back to, how do you look at your interest rate? What's your pricing targets? And those, I think the Chinese try to link them into what they call the social capital formation, which is investment funds, and also look at the tax receipt from different regions. You have regions such as Guangdong, Jiangsu. Those are two leading ones, or Zhejiang, we want to add one more. They actually, the economy, those regional economies are doing well. But if you go to others, now they may not. So they have to take pretty much strike the balance. So that's not easy to do. But they at least have that in mind to try to make the market more responsive to the fiscal condition of the country, tax receipt, taxing mechanism reform. Those actually put all into one basket. So it's not as simple.
So the balancing the growth across the economy is still a challenge. Thank you so much. Great to have you here with us. That was Perry Wong, Senior Fellow at the Milken Institute.
Mid-middle there in Hong Kong. Let's get back to the markets. But of course, our Milken Institute Global Investors Symposium coverage continues throughout the day. In Hong Kong, we'll be speaking exclusively with Goldman Sachs APAC ex-Japan President Kevin Schneider and the CEO of AI startup Upstage. A little bit later on, the Indonesian Investment Authority CIO will join Insight for an exclusive interview. As I mentioned, let's get back to these markets, which are really unwinding any sort of semblance of anything sort of close to stability at the start of the session. At the moment, we are really seeing that whipsaw session headed even lower, and really is across all asset classes. Perhaps these retail investors getting hit more than most, given that we've seen gold already seeing one of the worst trading periods in about 4 decades, continuing to head lower there. The MSCI Asia Pacific there down by 2.3%. All of the subsectors across the region trading lower there, and we are seeing sort of some marginal gains when it comes to energy stocks, but everything was headed in one direction. South Korea is one of the worst in terms of the sell-off so far. The Kospi falling 5%. These concerns over the Iranian war, the crisis, the deadline, we're just under 24 hours now from President Trump's deadline to reopen the Strait of Hormuz, and we are seeing that firm risk-off situation. The Wong weakening to the lowest since 2009. The TSE growth futures circuit breaker has been triggered in Japan as well. So lots going on. We'll bring you more on the Asia trade. This is Bloomberg.
Alrighty, taking a look at what's happening in the market session so far. As we said, it's a very broad risk-off session, which we actually had seen really being indicated with futures coming into today's trading. But it's that story around this arbitrary 48-hour deadline that President Trump has set and the risk that the war escalates from here. But let's bring in our MLive executive editor, Mark Cudmore, joining us from Singapore this morning. So Mark, I mean, it's very broad-based, but which asset class are you watching and what are you seeing as sort of the key driver of the dynamic of trading today as well?
Driver is that people are positioned very optimistically. I think the underlying narrative is that Donald Trump cannot afford for energy prices to stay high for too long and therefore materially impact global growth and hurt stock markets with the midterms coming up later on this year. So because of that narrative, equity investors in particular have been kind of going, look, there's got to be a solution found some way, even though they don't know exactly how that solution might work, or some of those solutions sound a little bit kind of overly optimistic, to put it lightly. That's kind of the way people are kind of positioned, because the theory is that if there is an opening of the Strait of Hormuz very soon, well, then stocks can really go gangbusters, because there is a glut of energy out there. It just needs to get to the right places, and the underlying macro trends before this conflict were extraordinarily positive for global stock markets. The problem is there's just no obvious off-ramp. And I think the analysis has continued to focus on what Trump's off-ramp is without thinking what Iran's off-ramp is. Iran is in control of the Strait right now. And there are many plausible interpretations where Iran is essentially winning this war. So it's what's their reasons for kind of stopping or standing down. And people aren't discussing that enough. And because positioning is very, very complacent, it means the underlying trend for stock markets is lower. In a normal environment, stocks are an inflationary asset, so they grind higher over time. That's the general trend, is over time they will go higher in maybe a volatile fashion, maybe gradually. At the moment, the underlying trend is lower because people are positioned incorrectly for the fundamentals that happen out there. Now, I don't know how the conflict goes. I don't think Donald Trump knows how the conflict goes. I don't think anyone really knows how it goes. But all I can say is that investors are positioned extremely positively. Now, that might happen. Maybe we'll get a wonderfully clear strait within a couple of weeks and we can move on from this. I find that extremely unlikely, and therefore this is the worst month for global stock markets in 3.5 years, and I think it's going to get materially worse from here, is the base case assumption, unless we do get some miraculous resolution.
Mark, I also wonder what Israel's off-ramp is, if they want one at this point too, right? How much of this is really coming back to the strength of the dollar?
I think the dollar, it will continue to be a beneficiary, but it's going to be a lower beta beneficiary from here. So at the initial stage of the war, dollar did really well, which makes sense. US is a net energy exporter, and people were positioned very bearishly dollar. So in the initial stage, you're going to blow up some of the consensus trades. I think from here, the dollar will still continue to gain because it still is a net energy exporter. And, you know, we're going to have wealth destruction. We're going to have global deleveraging, and that means going back into the world's reserve currency, and the dollar is still the world's reserve currency. So the dollar will continue to gain, but it'll become a little bit more choppy and difficult from here because ultimately what this is doing is undermining US hegemony, in the idea that they control the world, that they can police the world. They no longer, that's being shown up as invalid. They can't actually keep the strait open even when they want to. And therefore that has continued to undermine the dollar. And what's going to happen ultimately, very slowly out of the situation, is that ultimately people are going to want to, the Iran's already suggesting that people can pass their ships if they don't trade in dollars. They trade oil in other currencies. Now that's unlikely to fly anytime soon, but it's another kind of stamp in the idea that, hey, the dollar doesn't control the world as much as people think, and therefore people are going to want to move away from it. So the dollar will gain in the short term as long as the conflict ends, but it's doing another nail in the long-term coffin of the dollar's supremacy.
Bloomberg MLive Executive Editor Mark Cudmore there. We have more ahead on the Asia trade. This is Bloomberg.
You're watching the Asia trade this morning. We're just under an hour into trading so far for the Nikkei and the Kospi, and you are seeing absolute carnage, really, that's building across these markets today. Kospi, of course, the real standout to the downside. You've got the likes of SK Hynix, Samsung, but of course, a lot of this is around this changing expectation, not just what the Fed does, but also central banks. And we've got a new BOK governor that also sets the tone, perhaps, for even further tightening this year. So you're seeing that very much reflected. The Korean won as well, weakening to levels we haven't seen since 2009. Nikkei 225, of course, you can't go past that near 5% drop today. It is playing catch down, Haidi, after a long weekend holiday.
Yeah, a lot to catch down on as we continue to count down to President Trump's, as you said, fairly arbitrary deadline of 7:44 p.m. New York time. That's just under 24 hours from now, where he said that he wanted the Strait of Hormuz to be reopened or that retaliation would take place in terms of the power assets. We also had Iran also verbally responding and saying what sort of reprisal might be in store if that eventuated. So not a whole lot of good news for these markets. You can see Hang Seng futures priced firmly lower. We're seeing TAIEX futures down by 3.6% there as well. China futures, as we've seen, a little bit more sanguine, as we heard from Chinese Premier Li vowing to back balanced trade. We've seen Chinese exports surging again. Our coverage of the China Development Forum also continues today. This is Bloomberg.